Hi, everyone. Welcome to the show. So this is Gareth Soloway. Gareth Soloway is a professional trader. He makes his living from trading stocks and options and everything. So he's going to talk about Bitcoin's chart.
Bitcoin, where you definitely saw this kind of retrace. In fact, let me bring up the charts. Here's the 2013 cycle. And you can see we had the high here. We retraced. We never took out that 1250 level like we did recently. So that what that means is it's different than the previous cycles. And if we go to this cycle, which was the 2017 cycle, same thing. You had a big drop, a big retrace, but you never took out 20,000 before it bottomed out. So what that tells us is that this cycle, it doesn't necessarily tell us that this isn't a cycle top, meaning it's still technically a double top resistance. It's still struggling around the April 2021 highs, but you can't, as a technical analyst, compare it to past cycles. You can't say, oh, this is exactly the same.
Right.
So as a technician, I have to look at that and I say, okay, I have to go back to the drawing board. This isn't like the past cycles. It may still be a top. Ultimately, I still believe that when a deleveraging event occurs in the stock market, you will see a significant decline. The question is, how low will that decline go? Just to put it in perspective, yesterday or 2 days ago, we saw a big drop in the stock market. And Bitcoin initially was up that day and ended up flushing, which shows that that deleveraging event, even as minor as it was in the stock market, did have an impact on Bitcoin. So I do want investors to be aware that if the stock market does start to come down, then likely it will take Bitcoin down in the short term, even though long term, I think it will do very, very well.
All right, so a bear market is when you make lower lows and lower highs, right? So this event that happened, right, when Bitcoin tumbled down to 29,000 or whatever, then it started moving its way up, and now it's above the previous all-time high, and it's resting on the previous all-time high. So Gareth is still concerned about a deflationary shock like we had with March 2020, but it's looking a lot better than the previous cycles that we can compare it to.
So the one awesome thing that I saw in Bitcoin was when that CPI number came out on this past Wednesday, right? I think it was Wednesday, is that we did see cryptocurrency shoot to the upside. You saw Bitcoin literally intraday take off for about 30 minutes to 40 minutes straight up. And that's very key for the long-term success of Bitcoin in terms of being a digital gold or a way to curb your exposure to inflation. So that was really positive. The only negative was that then the rise in interest rates because of the hot CPI caused kind of this sell-off in the stock market that eventually brought cryptocurrency back down. But I love seeing the reaction that makes it kind of the gold type play where, again, I do believe that long-term it is the digital gold of the future.
All right, so we had 6.25% CPI numbers, which is the inflation numbers that come from the Fed. They're supposed to have 2%, and they overshot it by a 3x, over 3x. So Bitcoin reacted to that in a positive manner, and now we're getting this $1 trillion infrastructure bill that's being signed. So that's just adding to this mess.
What did you mean by that?
Well, again, the dual mandate came in, right? And the dual mandate said, so before 1977, the Federal Reserve basically had to just focus on making sure the money supply was proper, inflation was doing the right thing, and that was their only deal. So they could be the kind of the tough parent in the room, the strict parent, which is what the economy and what the monetary system needs. But in 1977, they got this dual mandate that said, well, now you also have to make sure that that unemployment stays low at the same time. Well, if you need employment to stay low, you have to have people have more money, so you have to push the market up. If you do what the hard, strict parent should do, which is be firm and raise interest rates, well, then unemployment's going to skyrocket. So you can't have it both ways. And this is the problem that is going to lead to the demise of the central bank system. Eventually, the Fed central banks are just going to continue to print money. They're not going to be the strict parent because eventually you'll see a collapse in the market and they'll have to print even more. And eventually the system just kind of, no better term, kind of blows up in terms of the monetary system. And you'll have to see a reboot. The Federal Reserve will no longer exist in their current form, in my opinion. And you'll have a redo of kind of a digital type asset, which will become the kind of the new dollar. I don't want to say dollar because I think the dollar will be diluted at that point, but you'll have some sort of reserve currency that emerges that'll have strict implications on how much can be printed on a yearly basis. So the government can't just print a ton, and the Fed can't do it at all either. And that's what the people are going to demand. You already see it out there. You see this restlessness with inflation starting to soar. The middle class, the poor people are already starting to feel, 20% rises in all these different goods. It's starting to hurt, no doubt about it.
So first, the Federal Reserve, right? There's been other central banks in U.S. history besides the Federal Reserve, and they have failed before. Now, with CBDCs and digital currencies, monetary policy can be baked into the code. So the code can have a monetary policy preset that is insulated from human error, right? And now with decentralized oracles and we can bring in price feeds from the real world into this digital autonomous system, we could have a really sophisticated monetary policy that would be, beneficial for everyone. So this is Caitlin Long. Caitlin Long is the founder and CEO of Avanti Bank, and she wants to share something.
What the President's Working Group paper has done is say, and by the way, they don't need congressional approval to enforce this, that stablecoin issuers have to get FDIC insurance. What's the impact of that? Well, there's not a single crypto native company that has even applied for FDIC insurance yet. There's a reason for that, but that's the fact. Actually, there's one that has applied, but the application was withdrawn. So now all of us are starting from scratch to get FDIC insurance. It's a fascinating fact pattern because the incumbent banks already have FDIC insurance. And I certainly hope that the intent wasn't to create a structural advantage for the incumbent banks, because all of the startups are now scrambling to get FDIC insurance. And I can break a little news this morning. Last night, Avanti's board voted for Avanti to file for FDIC insurance, and we will be dropping that FDIC insurance application very soon. But most of the crypto intermediaries are not structured to become FDIC insured banks. They don't have the capital. They don't have the compliance. They don't have the management teams. And very importantly, they're not ready to comply with the Bank Holding Company Act, which puts some pretty serious restrictions on affiliates as well as on the cap tables. The banks, for example, are not really allowed to have preferred stock in their cap tables. And boy, there's a lot of venture capital money and a lot of crypto intermediaries that wouldn't comply with the Bank Holding Company Act.
So the Stablecoin President's Working Group and stablecoins, they're proposing regulations for stablecoins, and it sounds like these stablecoins are going to need FDIC insurance, which limits who can actually issue stablecoins, and it looks like incumbents have the FDIC insurance. So the SEC and the FDIC were the regulators to really drag their feet for all this, and now it looks like it's looking more and more favorable towards the incumbents. And a lot of these crypto companies are not going to be able to issue stable coins. They're going to need the backing of one of these really large banks. So this is Michael Saylor now.
If you're a small crypto startup, this is a bit scary. If you're Jamie Dimon, you were waiting for this before you considered getting into this business. And now the question is, which of the big banks are going to move first, and which of the crypto native players are going to cross the chasm to become institutional public grade?
And how many of their developers will stay working for them if they get acquired by big banks?
We got to grow up at some point. There's a lot of Bitcoin maxis that don't like the idea that publicly traded companies own Bitcoin. But that doesn't stop me from buying $3 billion of it. And there's a little friction between the past and the future. And who's going to impact this decentralized crypto economy?
So the incumbents like Jamie Dimon, the big banks, right? They've been waiting on the sidelines for this very moment. They've been waiting for the President's Working Group to issue stablecoin regulations that are in favor of them, right? So Michael Saylor, it's ironic that all these Bitcoin maximalists really look up to Michael Saylor, but this is what he's he's looking forward to is for the big banks to jump in with and start, creating their own stable coins and bringing in all the institutional wealth through their regulated stable coins. So I thought that was pretty interesting. The next piece of information is iTrustCapital has announced there is no monthly fees for their platform. So, iTrust offers IRAs to insulate your crypto gains from taxes. So this is a legal way to pay less taxes. And now they're doing no monthly fees. They also have precious metals. They have a lot of cryptos. And I know they're working on an app for your phone to access the iTrust platform. This is the next piece of information. This is David Malpass. This was November 8th, 2021.
Great. In a world that's unequal, remittances really are important. The workers working outside their border
sending money back.
The spread is just too expensive, and so countries can fix that by becoming more digitalized. You know how phone apps are now working in some countries, even some very poor countries.
Much more advanced than in the United States. So M-Pesa is famous in Kenya, for example, for this?
Exactly right. And what's happening is you're arbitraging the clerk at the bank. That clerk is making more money than the customers. In most poor countries, a bank clerk is doing pretty well. So the poorest people in the country simply can't wait in line and go to the bank. They need to have it on their app. So the governments need to allow that, and that gets into the breaking
regulations. You got to get the banks to agree to it. You got to get the telecoms to agree to it.
Get everybody on board, and so World Bank is actively working in that country by country, but you've got to break down the monopolies, and that's been one of the big problems. Now, good news, along the west coast of Africa, there's now a choice that countries are beginning to have in terms of their undersea cable. One of the challenges for the world is in a lot of places there's only one undersea cable and the government controls it. If you can break through that, then you can get more digital transactions occurring and the cost goes down.
It's like a water pipe. Instead of having one water pipe, you get multiple water pipes.
Two, and you can choose. So one thing I'm trying to do is, as we think about financial inclusion, recognize that one good metric for that is a huge volume of transactions at a fraction of a cent. We can't be talking about $3 for a transaction in poor countries. That might work in the U.S. When you go to the ATM, you pay $3.
I paid $3. But my wife caught me one time. I went to the wrong bank and I paid $5. She sent me a nasty gram.
So, yeah, don't do that.
Don't do that.
All right, so the World Bank, the IMF, they have a few roles, right? And one of their roles is they offer guidance for all these developing nations on their banking regulations and technology regulations, right, for banking. So, the World Bank is suggesting to some of these developing nations favorable regulations towards technology, right? So David Malpass is telling you about different types of platforms that work on your cell phones and everything. Now all these platforms that Ripple has partnered with, right? Like the Kuwait Financial House and InstaRem and so a lot of these platforms, it's all on the cell phone, and what RippleNet is it's on the back end for those banks, like even Santander, right? They have their app, but it runs on Ripple. The back end of it is using Ripple technology. It's just the front end. So the World Bank, the IMF, tells all these developing nations to upgrade for technology, and we're seeing a lot of traction with Ripple. So this is Chris Giancarlo. This is November 15th, 2021, and this is some information from Chris Giancarlo.
Payment rails that are outside of that control. And tokenization is very scary to those who are the overseers of account-based money systems. If you're in a correspondent banking is right in the crosshairs of digital assets, right? It's a huge rent collecting that soaks up 1 or 2% of global GDP just to move money around the world. Think about how Kodak must have felt when digital photography came about. Well, in the same way, if you're running a correspondent banking, you've got to be really afraid of stablecoins. So there's a lot of fears to legacy systems. What I tell fellow regulators is, don't confuse the state of the art of a method of achieving policy with the policy itself. AML KYC, as we currently know it, is based upon identity as the first step in every transaction. Why is that? Because our account-based money system requires identity as a first step in every transaction. Somebody's got to identify who you are, where you bank, and how much money's in your bank before you can use a check or a credit card or Zelle or Venmo, right? As we move to a token system, we don't need to establish identity in every case, although we can unmask identity in a pseudonymous system later on if pattern recognition shows us there's something that needs to be unraveled. But for many...
All right, so the incumbents have the most to lose from all of this, right? And it's like Caitlin Long said, the president's working group with the stable coins, it looks really favorable for the incumbents they kind of have a reserve spot for crypto by issuing stable coins. So, if you've been watching my videos for a while, this is something that I've been talking about for a while. The incumbents are going to merge with crypto. It's not going to be this decentralized utopia. You're going to see the big banks get in here. Now, Christian Carlo is saying that the regulators traditionally have always worked with the incumbents, right? So the incumbents are the ones that enforce all these regulations, the KYC, AML regulations, and now with artificial intelligence and blockchain and ledgers, right, the AI can study the ledgers and pick up on unusual activity and then report it. And then, you can have this pseudo-anonymous system where, you utilize something like zero knowledge proofs where you don't see anything unless there's something to trigger something, and then you'll be able to see into the transaction. So, I'm a little bit pessimistic. We can already see this with big tech today, how well that's going.
A wheat contract at the end of the period, you've actually got to deliver the wheat. Well, actually, we greenlighted 2 types of Bitcoin futures at the CFTC, a cash-settled one, which is the CME product, and a physically settled one, which is the backed product. As I understand the ProShares ETF, it's based upon the cash-settled one that CME does.
Yes. It's
very possible, though, that an ETF could be launched, and maybe there are applications in front of the SEC right now for a Bitcoin ETF that settles on the physically settled Bitcoin futures at backed. I have to say I don't know if there is, but there's no reason why it couldn't. Whether the SEC would approve it or not, I don't know. But in a construct that you could have an ETF constructed that way.
So the Bitcoin ETF that was recently announced, it's all cash, right? So it's just kind of betting on the price, the future price of Bitcoin, right? And it's settled in cash, so it still comes back to dollars. There's no Bitcoins involved, and a lot of Bitcoin maximalists say that the spot Bitcoin ETF is going to move the price when the institutions have to buy the Bitcoin to settle it. And that's probably why we're seeing such delays in it.
In the futures market. Why is that? Because the big institutional players, the big hedge funds, the big money management funds are actually not engaged in those spot markets for the most part. They're doing their major institutional buying and selling in the futures markets, and there's retail there as well. I wouldn't say that the shift of where the price is set is fully flipped over to futures. My understanding in talking to people in the market tell me it's probably still somewhat 50-50, but the trend is going more and more to the futures. And that's an organic, natural process that takes place in most futures markets. Once upon a time, the price of wheat was set when the farmer sold it to the grain elevator. Today, it's set in the various wheat markets in Chicago, in Kansas City, and Minneapolis. And similarly, That's starting to evolve in Bitcoin. And I'll add one more thing. There may be some people that are concerned about that. Ultimately, that's a good thing. One of the strong underpinnings of the US dollar as a reserve currency is most of the world's major commodities and benchmarks are actually made in dollar-based futures market. The fact that the price of oil is set in US markets in dollars is a huge strength to the US economy. The fact that soybeans, the world's most important edible commodity, is set in U.S. markets is a huge strength. You know, when a soybean farmer in Argentina sells soybeans into the world, he's not only going to worry about the soybean price, but he's also got to worry about the conversion from his currency into the dollars. American farmers don't have to worry about where the dollar is in global markets, so he doesn't have to worry about it.
So all these futures markets, right? He's saying that everything's pegged to the dollar through these futures markets, and the world's uses our markets as a gauge to price everything, right? So, ultimately this will just strengthen the U.S. dollar is what Chris is trying to say. And this is the last part with Chris.
Since I left the CFTC as a private citizen, I did publish a piece in the spring of 2020 in the International Financial Law Review stating my view as a lawyer, that XRP is not a security, and we'll see how a court determines that. But that's a published piece that I put out.
Well,
but I didn't.
So Chris has when Facebook had the Libra announcement, right? There was a congressional hearing, and they called Chris to the hearing. You know, he's got a pretty good. He's got the ear of a lot of regulators. His opinion is respected and everything. So he says XRP is not a security. So that's a great thing for us. Now this is the FTX CEO. His name is Sam Bankman-Fried, and let's hear what he has to say.
Prepared for.
Yeah, I mean, one thing I'll say is I totally think that that there is a lot of resistance from a lot of players to switching to sort of a new regime here. And I think that it comes from a number of areas. I think one of them, frankly, is just it's work. It's a lot of work for a lot of people. Like, we've had banks tell us, slow down. Like, we're getting like hundreds of wire transfers from you per day. Like, we can't handle that. And I think we're sort of like, that's your job. Like, you're supposed to be the pillars of our financial system. And in fact, it's like legally mandated that every transfer routes through you. Like, what gives you the right to object to transfers because there are too many? Like, it's like too much work. Like, I don't know.
Right.
So the whole world is updating to crypto technology, blockchain technology, where everything's moving at the speed of light. You're seeing Switzerland move their whole stock exchange and tokenizing all of their stock. So this behavior from the incumbents is not gonna stay like this forever, right? So he's saying just with his crypto exchange that they have so much volume, so many wire transfers that the incumbents are telling them, slow down. We can't even handle this much. So, this is going to change, and we're watching it change. It's just going to take a little while. So remember, my link is in the description below. It's also going to be pinned in one of the comments. So if you want to buy an IRA where there's no monthly fees and there's tax incentives to hold it, please use my link. I hope you enjoyed the video. Have a good night, everyone.